Well, the way to think about ARM's quarter and their guide, I would say, is that in itself, it was not too disappointing. Top line numbers hit, guidance was maintained. It was not raised to your point, but it was maintained. But within that guide, what we saw is that royalty revenues, so income of chips that they delivered over the last quarters, was lower than expected. And that was partly offset by stronger licensing activity related to AI chips. But that weaker royalty, which is mostly caused by industrials, by networking, by weakness in those segments of the market, that I think has spooked investors a bit. It's clear that for the current year, there's limited upside to current estimates.
Hence, the rather conservative price target that you have of $115, and you are neutral on the stock. What do you need to see then in terms of qualification and commentary and a workaround from management to give you more conviction towards ARM?
Yes, of course, ARM has done remarkably post-IPO. I think the IPO price was $51, if I'm not mistaken. The stock trades at around $125 after hours, so it has had an amazing run. But when we look at the fundamentals, what we currently value ARM on is 40 times 2028 EBIT of 3.8 billion, and we discount that back to today. A 40x multiple, that is rich, that is in line with the cadence, with the synopsis, with high quality names, with very high margin profiles. What we need to see for further upside is ARM continuing to raise its royalty rates as they deliver more complex processor architectures, and that boosting royalty revenues more than what we currently forecast.
So Rolf, to Sri's point, ARM right now after hours down about 11%, 125. You've got a 115 price target. Let me ask you a cheeky question. What do you think is fair value for ARM?
Yes, it's ARM is a challenging stock to own as an investor, because that only 10% of ARM is actually publicly traded, 90% owned by SoftBank. So that very limited float makes it a difficult company to own. Right? I would never recommend to sell the stock, because it could well do very well over the coming quarters, simply because the float is so small. But we think that a fair price is 115. We would become more constructive when we get to that level. But anything above that, we would not recommend to buy the stock.
Which is where we are now, 125. That's even after being down about 12%. Sure.
Yep.
As far as Qualcomm is concerned, it seems to be one of the few chip names that have been managing expectations with regard to the export restrictions on chips to China, and also managing expectations with regard to a much more heated environment when it comes to US-China trade tensions as well. Should more chip suppliers be managing expectations and guiding more conservatively?
Yes, Qualcomm, of course, is in a different business from an NVIDIA, who supply very advanced AI chips, or even from an ASML or Tokyo Electron that were mentioned earlier, that supply the tools to manufacture those advanced chips. So in that sense, every company has its own complexities to deal with when it comes to China. For Qualcomm, they have handled the situation fairly well. That said, I think looking at the business fundamentals, there are some challenges that they're facing with an uncertain refresh cycle in smartphones, and perhaps also potential for disappointment in traction in PCs, which is a segment that they're heavily touting as the next growth engine.